Nasdaq-listed iGate has posted its first quarter results that came in line with estimates. While the revenues were just a shade above the $300 million mark, the net income was just about $31.5 million. The companies have added 9 clients during this particular quarter, and software majors such as Infosys, TCS have been very cautious in their commentary in the last few weeks. In fact, iGate management says that the overall conditions appear to be favorable, which is in contrast with some of the large cap peers are saying, and that this company has a very healthy pipeline of deals going forward. Let's talk about all of that commentary in detail with iGate CEO Ashok Vemuri joining us for an exclusive interview on the phone line from New York on their first quarter performance. Mr. Vemuri, thanks a lot for joining us on the phone line today, this evening on the show. Let's start with the performance in this particular quarter. Your revenues were in line, profits were slightly lower sequentially. What were the drivers this quarter for this kind of performance?
You know, in keeping with the strategies that we had outlined when I joined the company, we have been fairly successful in implementing them. We've been able to narrow the focus. We've been able to build assets under iTop's go-to-market strategy. We're beginning to see the results of the increase in volume and business as a result of the large transactions that we did in the previous year. We're beginning to see traction in our traditional IT services. Our verticalized structure is beginning to kick in. We're finding our leaders be more accountable, more responsible. Our clients are reciprocating very well to a verticalized structure and being able to bring to them technology and process solutions under the aegis of iTops in a manner and fashion which is very contextually relevant to them. So we're very happy with the progress that we're making. Of course, it's been only 90 days. We have to strengthen that, but I'm very happy that I have the right people. I have them in the right seats in the bus, and the bus is beginning to pick up momentum and acceleration. With regard to our margins, in the previous quarter, in the first quarter, we took a charge as a result of the visas. We again in the next quarter will see a slight suppression in the margins because of annual wage increases. But in spite of the investments that we are making in our business, in spite of the investments that we are making in the marketplace in terms of hiring, the cost of visa and the wage increases,
right,
we are committed to our long-term goal of 25% EBITDA, which we've been able to demonstrate in the previous quarter.
Oh, okay, but you know, you've initiated an internal reorganization as after you took charge. Is the new, verticalized structure now complete?
Well, the reorganization in terms of the vertical structure, of course, is complete. As I said, I have the right people. I have their confidence. I'm very happy with the way they have reacted and they have demonstrated their capabilities. I'm very happy with the way the clients have responded to this vertical structure. I'm very happy with my enterprise capability business units. As we build out our digital practice, as we begin to see more traction in our analytics business and our mobile business, we expect to bring in more leaders into that particular area. So we will continue to invest and hire in the marketplace, but my core team is in place. My core team is firing on all cylinders, and I think it is only a matter of time before we see the increased and enhanced impact as a result of their leadership and their responsibilities that they've taken on.
Mr. Vemuri, will you look at consolidating the accounts that you currently have, in an effort perhaps to focus on the high revenue yielding clients and maybe look at exiting from the smaller ones?
So we embarked on a management of tail accounts, which are accounts essentially those either in the geographies that we don't want to focus on or in services that we don't think are necessarily appropriate for our client as well as for ourselves. Excuse me. So we have disengaged from those clients, but we have a very robust set of accounts. We have large accounts that are doing well. Traditionally, they have been large partners of ours. We have successfully been able to mine our mid-sized accounts. That is the results that we are actually seeing in this particular quarter, and we expect to see going forward. We cannot afford only to concentrate on one set of accounts at the expense of others. We have some very large clients or large businesses in our mid-tier accounts. We've been working with them and engaged with them for over 6 to 8 years. So obviously we are doing the right things with them, and we need to expand our service lines with them. And we see the opportunity to do that both in the US as well as in Western Europe.
Right. Ashok, in terms of overall demand, where some of the warning bells are being seen coming in from TCS and Infosys in the last few weeks. Is the pain from the macro environment here to stay, in your view, or are these just company-specific issues coupled with the seasonality factor?
So I think some of this could be a particular company-specific, or depending on the markets they operate in. In the markets that we operate in, as you know, 75-77% is the US market, and about 15-16% is the European market. We are actually feeling quite buoyant about the market prospects, especially in the sectors of BFS, especially in the sectors of retail and CPG. There is some slack that we have noticed in the insurance sector, but that for us is a fairly seasonal event. On the whole, I would say we do not share necessarily the same level of tepidness that some of our larger competitors have expressed in the market, but that could be a function of themselves. All the markets they operate in, they are much more diverse than we are, and they probably operate in different places than we do.